Ready to face your fears head on, conquer them, and create a safer, more prosperous future? Worried that the world has gone nuts and you've become an insanity magnet? Then grab a cold libation, put on your fuzzy slippers, and get ready to create your own safe space. It's the Safe Space Podcast with your host, Tammy D. For more information and episodes, go to www.speir-podcast.com. That's www.speir-podcast.com.
Now, some of you are young and you're not even thinking in terms of retirement, but I assure you that's probably not the right thing to do. You should probably start thinking and planning for your retirement as soon as you start working. And I'm sure my guest today would probably agree with that, right, Larry?
Absolutely.
Larry Speir is going to be joining us today. He's going to tell us a little bit about himself, and he's also going to tell us about reverse mortgages. Now, a lot of people have a lot of misconceptions about reverse mortgages and what they do and do not do, and whether it's putting granny out on the street and a lot of other things that people believe. Now, why is it important to you if you're under 50? Well, if you're under 50, chances are your parents or maybe even your grandparents are going to either be confronted with the decision to take out a reverse mortgage or not, or they may have already done it. They may have even done it without even, telling you until much later in the game. And there may be some resistance because of that. There may be some resentment on your part. So we want to talk about how this can benefit not only your parents or your grandparents or your great uncles and aunts or whoever's, leaving you money in their will, but it can also ultimately benefit you. And so today, without further ado, I'd like to introduce my guest, Larry Speir. He is a financial educator, financial guru, however you want to position it. And he's also an expert in reverse mortgages. He's going to tell you a little bit about himself, how he got into this, and what he sees for the future of reverse mortgages, how they work, how they don't work, and how anybody can use this to build a better financial future. Welcome, Larry.
Thank you, Tammy. I appreciate the opportunity to come and be interviewed by you, and to be able to kind of share the information with your listeners. I'm 70 years old, so I am a baby boomer. I was born in 1951, even though I don't look a day over 30, I was 70 years old. And I've been working with baby boomers for a long, long time. I'm a licensed loan officer on the mortgage side of life, and I'm a licensed insurance agent, to be completely transparent. I know the troubles that boomers, many of us, are sitting in because we didn't start early enough, as you just said, in accumulating resources to retire. And most of us just can't get it through our head that we may live another 20, 30 years after we die. And as somebody said, when we retire, we're in a race. We're in a race with our money.
Wait a minute. We can live 30 years after we die? Come on.
I'm sorry. Well, that wasn't right, was it? Well, we could live forever. But
I was going to say that's a Freudian slip. But yeah, you're right. Absolutely. I have actually heard of people that were retired for 35 years. I can't even imagine that.
Absolutely. The goal in life is to retire early, although I can't imagine why, but that's kind of the goal for people. I mean, if you retire at 65, which is kind of the gold standard in our heads these days, at 35, you've lived 100, or at 100, you've lived 35 years. With advances on the medical front and surgical procedures and all of that sort of stuff, good chance you're going to live that long. Even if you don't, you've got to be prepared for that, because you sure don't want to run out of money when you're 89. Or 92. So it's a problem that most of us really hadn't considered, and it's a problem Social Security didn't consider when it was first created. So there's all kind of forces at work there.
The longevity sounds great on the surface, but from a mathematical and financial point of view, there's a lot of issues with aging, right? With just living too long.
No doubt.
So you've done other types of financial planning. How did you get into the reverse mortgage thing? Because, in my mind, the reverse mortgages are like Joe Namath on TV or some retired B-list actor who's trying to hawk these things, and it sounds slightly shady. So what prompted you to look at reverse mortgages besides the fact that boomers don't have enough money? And I'm telling you, Gen X, even millennials, could benefit from knowing this information right now, correct?
Absolutely. And you're right. The industry started advertising way back in the day with a guy named Robert Wagner. You younger folks will have to go Google that. But through the years, that's kind of how one of the ways that the story got told. Today, the most famous one, and he'll probably argue about B-list, Tammy, but it's Tom Selleck. The truth is that it's just a way to catch people's attention, and it adds to sometimes the value of telling our story, and sometimes it kind of counts against us. But the truth is, for the right senior, the right older American, a reverse mortgage is just another bucket of money asset that they have accumulated over the years that they're able to tap into to improve their end of life, improve their retirement in the end of their life. It's no different than having an IRA. If you think about it, 30 years you pour money into an IRA and then you begin to take money out. Well, if you think about it, in 30 years, you've poured money into a house. So why wouldn't you use that same asset in retirement? You have to overcome all those emotional feelings that come with that. And I expect we'll deal with that here in this conversation.
Well, absolutely. I was just going to say that a home is a very emotional thing to begin with.
Absolutely.
And the idea that some people have, and I've talked to people before about just in general about reverse mortgages, because they've told me, oh, my parents are getting a reverse mortgage, they're going to end up out on the street. And there's a lot of myth. First of all, I think we should define what exactly is a reverse mortgage in simple terms.
Well, let me do it two ways. A reverse mortgage is just a mortgage. It's a loan. There's nothing wrong with that word. It's a loan. Instead of you having to pay back or the borrower having to pay it back, the home pays the loan back when the home is no longer in possession of the borrower. So there's reverse mortgages, and that's kind of the big name. But yet there's a subset in there called the HECM, the home equity conversion mortgage. It's the 93% of all of the reverse mortgages that you hear about are HECMs. A HECM is a federally insured loan. Here's the definition. It's a federally insured loan product that allows homeowners age 62 and older to access a portion of their home equity in cash, in monthly payments, or a growing line of credit. With a HECM, the borrower retains ownership of the house, but must occupy it, maintain it, and pay all property charges. Bottom line is you're getting money out of an asset that's right now locked up in brick and mortar and windows and curtains, and you're turning it into cash that you're able to use any way you really see fit.
So it's like a HELOC, only going the other direction, right? Kind of.
Yeah, it's like a HELOC, except that it outperforms a HELOC because, as you may remember, HELOCs can be recalled. HELOCs eventually have to get paid back, whether it's in the typical HELOC today is a loan you get open. It's an open line for 5 to 10 years, and then immediately when it ends, you begin to have to pay it back. A HELOC can be recalled by the bank, i.e. 2008. Many of us remember that. And it can be frozen at any time the bank chooses to. When COVID first hit, immediately the big banks froze HELOC. You can't freeze a reverse mortgage. And again, you never make a monthly payment, a principal and interest payment on a reverse mortgage for the rest of your natural born life unless you want to. And there's some reasons people do, but you don't have to. You get cash out and not have to make a payment.
So I'm going to put this in more of a real world scenario. Let's just say that you have a couple, okay? The wife is 60 years old, but the husband is 68, okay? And their kids are growing in and out of the house. They have paid their house completely off, okay? So there is no existing mortgage, but she falls ill with expenses that are not covered by Medicare, which would be like something like a dementia maybe, or long-term care. Is that a common scenario where somebody comes to you and says, I need to get this because I need money to pay for these out-of-pocket medical expenses?
I'm going to answer that question and then another way, and then we'll come back and answer it directly. For years and years and years, even people who saw the value of a reverse mortgage only recommended them as a last resort. We're down to the end of the road. We need cash. We'll use the equity in our home. And this certainly still happens today. But the smart folk have figured out that a line of credit, if you buy into the fact that it's housing well, there are a lot of very smart people. Robert Merton, who's a Nobel Prize winner, Wade Pfau, who's very active. He's a professor in economics. There's a lot of the Sachs brothers. A lot of them will tell you that if you want to perfect your retirement, you go get a line of credit, a reverse line of credit at age 62. So there's a lot of reasons that you can use the reverse mortgage, but certainly long-term care is one of them. It's the great abyss that is facing most older people sooner or later, where they're going to wind up with some medical bills that they weren't planning to see, and Medicare doesn't cover them. Medicare does not cover long-term care other than 100 days. First 100 days, they got you covered mostly. But after that, you're on your own. If you've got assets, you're paying out of your pocket. If you don't have assets, then you're on Medicaid, and you're in that terrible Medicaid spend-down model. So certainly long-term care would be a way to tap into to have access to resources that they didn't have to tap into.
So you said before, though, that age 62 is the ideal or the youngest age to start thinking about this. But what if you have what if you have a husband and wife situation where one is that age and the other one is a year or two behind? How does that impact it, and how could you still get a reverse mortgage if you needed it?
Tammy, that's a great question. So typically in the old days, right, whatever that meant, like 2 or 3 years ago, in the old days, the non-borrowing spouse, which would be the one that was under age 62, didn't get a lot of protection. The older borrower would go on the note, would go on the other one could go on the deed, but would go on the loan. They live happily ever after until the older one dies, and then this is before the non-borrowing spouse then has a short window to get out of the home. Today, the FHA has really tightened that up. FHA now gives a non-borrowing spouse complete protection in that home for the rest of their life. At age 62, well, to answer your question specifically, at 62, a 60-year-old cannot get a HECM, right? But because they're married to an older one who can qualify, they can ride on the note and they would have the protection, but the amount of money, what they call the principal interest in our business, which is the principal amount that they can get out of the home, is based off of the younger age, not the older age. FHA establishes, it's all set by the FHA. The FHA establishes a grid based on the age of the people. And so they're not going to let you drain every dollar out of equity out of that house. That's just not possible. At 62, you're going to get about 50% of the available equity in the home. That's kind of all you're going to get out of that thing. The older you get, the more you're able to, percentage-wise, you're able to pull out.
Yeah, that does answer the question, and we might as well follow along with this fictitious couple. We'll call it, let's call
Sure.
them Jim and Karen, okay? And
All
Karen's
right.
the younger one, and Jim's the older one. Now, besides we've mentioned long-term care needs or memory care needs or something medical, what other things, what other creative reasons could Jim and Karen want to take out a reverse mortgage on a home that's already paid for? I mean, why would they want to do this?
Here's why this has become a very hot button for financial advisors that are kind of in the know about how to use them. You can get what's called a line of credit. So a line of credit, you can go in and again, you got to go through the underwriting and all that. But let's say that they have access to, I don't know, $300,000 worth of equity. Instead of taking that money out and using it or putting it in the hands of the advisor or whatever you would do with that thing, they could establish that $300,000 as a line of credit. Here's a powerful, powerful tool. That line of credit is guaranteed to grow at whatever the interest rate that's on the reverse mortgage. Just I'm plucking a number out of my ear. If the mortgage is at 4%, then that line of credit is going to be guaranteed to grow at 4% over the life of that mortgage. I mean, there's no place in America, well, there's no place that I know of that you're going to go out and get a 4% guaranteed return. Now, again, it's kind of a little bit apples to oranges, but that line of credit, which can be drawn off of in the future, it's a beautiful way to let a tool work and grow for you.
If you pull it out, you've got it sitting there, and you don't use it, right? Until you need something major, something happens, the roof needs to be fixed or whatever. Yep. Because I know one of the provisions of a reverse mortgage that's really important, I guess it's in most of them that I've seen, is that you have to keep that house well maintained. And you have to, and you can't be away from it for more than a certain period of time, right? You can't have renters in there. You can't have, it's got some restrictions.
It does. And it does because, again, it's guaranteed, right, by the FHA. So you're going to live by the FHA rules. It has to be your primary residence. Now, there's a lot of wiggle room in that. I mean, the examples are, snowbirds, if you live in Michigan and half the year in, in Florida or Arizona, that works just fine as long as it's your primary residence. If you go off on a mission trip for a year, that's okay. It's still your primary residence. So, and every year you sign an affidavit stating that's your primary residence. Secondly, you've got to maintain the home because you need to make sure that the home stays of value, and that protects both the lender and the FHA.
And that makes sense. They're protecting their asset. That's really what's securing that loan, right? That's I live in California, and it's kind of its own world, especially in the area of real estate. So what happens if, like, say Jim and Karen, they got this house and they bought it at the top of the market. But when they get ready to go for the reverse mortgage, they realize that the value could fall further. So what if the value of the home actually gets to the point where it's fallen so much that your loan is more than the value? Does that happen?
It certainly did in 2008, 9, and 10, didn't it? My crystal ball is always very cloudy. But I believe that when we look at this hot real estate market that we're in, and remember, I'm a mortgage guy, so I watch all that mess too, is that I believe we may be, may be nearing the high water mark of home values. There is almost $11 trillion worth of equity sitting in older homes today, up from $8 trillion 2 years ago. Now, that's a lot of money. So, but you ask a great question. What happens when if the market turns and it goes upside down? Here's the magic word when it comes to reverse mortgage. It's called a non-recourse loan. meaning that you can get in that house, you can borrow you can get the money out of it, you and the protected spouse can live in that home forever. If the market turns sideways like it did in 2008, I don't think that'll ever happen again, but God forbid. But if it did, and you died and go on, then your heirs are upside down in the house, right? Except the heirs walk away from it also. There's no recourse back to the loan unless there's a positive cash flow or a positive asset.
Right. And you mentioned the heirs, and then that's going to be a real sticky subject there. But as far as the heirs are concerned, if they want to, at any point in time, can they take up paying this so that they can retain ownership?
Absolutely. Payments on a reverse mortgage is a voluntary thing. You can make them if you want to. When you make those payments on the bulk of the loans that go out today on an adjustable rate with a line of credit. So anybody that wanted to make a payment to the lender can do that, and it pays down the line of credit. So again, there's more money available in the line of credit, less on the debt, and it can certainly work very well. There are people that'll tell you that if you are in feast and famine industries, like real estate, right? That real estate agents, when they hit 62, or insurance agents, right, ought to go ahead and get that line of credit. And then when things are lean, then you can pull off that line of credit and not have to go into your other savings. The money that comes out of a HECM, a reverse mortgage, comes out tax-free. It's not a taxable event. Whereas money that comes out of an IRA or a 401k or a TSP or whatever, that money is taxed at whatever their taxable rate is for the year. You can make a very good argument that to get $1 out of your housing wealth is a whole lot cheaper than the $1.25 you got to get out of your 401k to get the same dollar. So there's a lot of flexibility that happens inside that reverse mortgage that you can use.
So it would be a savvy thing too, if you're getting ready to retire, you're within a few years of retirement and you're in your 60s and you have debt, you could also profit by paying your high interest rate debt off with this loan.
Absolutely. And again, because it's the same thing. I mean, there's all kind of reasons for having that line at 62. There's all kind of reasons to have that line of credit in place, right? You know, you get ready to retire and the market takes a hit like it did in 2008 when your 401k became a 201k. You don't want to be pulling off of that amount of money when the economy is bad and the market's upside down. Go look at your 401k value today. And you got to understand, that's not real money. That's just on paper. When that market slid 1,000 points the other day, your 401k did too. It went maybe not 1,000 points, but it went down also. So it protects that sequence of return. You can use it to extend how far out you want to take your Social Security. You pull off the reverse mortgage until you're 70 instead of 66. And there's all kind of tools you can do with it, Tammy. The one that we really like to talk about because it's just so fun in the right circumstances is everybody that's got a whole lot of money sitting in a Roth, or not a Roth, but sitting in a qualified plan, know in their mind, they might not want to admit it, but they know in their mind that the tax man is coming when they hit at least 72 today, right? The taxes that they are going to owe on that money will be substantial. And so everybody, is wanting to talk about doing Roth conversions, and it can be for lots and lots of people a wise thing to do. Yeah, I want to do a Roth conversion, but I don't want to write the check to the IRS today. We just don't want to do that. So one way to do a Roth conversion in a very tax efficient way is to use the proceeds from that reverse mortgage, spread out the payment to do the Roth conversion over 5, 10 years, doesn't matter. But instead of pulling that money out of your 401k to pay it, you pull the money out of the reverse. Now, if you think about it just a minute, you've got taxable money. You're going to use non-taxable income, not income, but non-taxable resources out of the home to pay the tax on that taxable money to make it non-taxable. Then you can either pay the reverse mortgage back, or you can just leave it alone. It's just a win-win deal for the right set of circumstances. Of course, I'm not your accountant, and I'm not your CPA, and I'm not your financial advisor, so always, that disclaimer. But it's a heck of a way to do it.
Who is, if you had to design marketing materials to reach the ideal demographic for a reverse mortgage or a reverse mortgage line of credit, what would that person look like, or persons?
Well, there's probably more than what I'm about to say, but there's probably at least 2 or 3 targets, Tammy. One is the people who need the money. And if you got to get money, if you've got to raise cash, doing it effectively and efficiently out of the home equity as opposed to cashing in a 401k or an IRA, that is still a very large chunk of the market. If I couldn't go after but one target market, I think I would target the people who are in retirement, who have a line of credit or a mortgage payment they're paying every month. Over 60% of people go into retirement still carrying a mortgage payment with them. How would your retirement life be better if I could show you how you never had to make that mortgage payment every month? And so that's probably, again, if you think 60% of all the boomers at 65 that's going to retire this month, 60% of them are carrying a mortgage payment. I'd like to show you how to get rid of that bad boy. So that would be another one. And then it segments, Tammy, to aging in home. Nobody, after COVID especially, nobody wants to go into a nursing home. Listen, if I have my choice, and I need a little attention, I much would rather have somebody come into my home and me sit in my Barca lounger and let them do that for me, instead of me living in a place where I don't control my own destiny. And now a lot of people disagree with that. But aging in place is one of the largest segments of opportunity, because 65, you know the deal, 10,000 boomers are turning 65 every day, and we haven't hit the peak yet. So lots of different markets out there, but just statistically for you, the average age of a reverse mortgage borrower today is 72.
And that makes perfect sense to me, but I'm still astonished at the statistic that over 60% of Americans still have a mortgage going into retirement. I can understand that because home prices are crazy. They're insane here in California. I don't even know if 40 years is long enough to pay off a home here, if you think about it. But it's crazy going into retirement on a fixed income and having that.
Yeah, there you go. Thank you very much. And so but the reality of it is that, listen, I'm a loan officer. I can say this, right? We lured people to refinance their homes at a lower rate. Well, most people, when they did that, what did they do? The first thing is they took money out of the house and paid off, went on a cruise, did whatever. The second thing is that when you refinance a mortgage, you started the shot clock all over again. That 30-year mortgage that you had paid down 7-8 years is now another 30-year mortgage. But again, there's lots of people who do live in a home completely free and clear. They are the best candidate for a reverse, because when you go and get a reverse mortgage, the first thing they're going to have to do is pay off your existing mortgage.
Somebody that has a free and clear house, then what are you typically seeing as far as loan to value? I mean, is it all dependent on their age, or are there other factors? I mean,
yeah, that's sort of a great question, but kind of phrased on a forward mortgage basis, but so let me see if I can do it for you. Loan to value is kind of the same thing, but remember there's a formula that the FHA has established that tells you how much of that principal you can tap at the age of the youngest borrower. To get 80% value, you're going to be in your 90s. The good rule of thumb is that at age 70, which happens to be how old I am, at age 70, you're going to have access to about 60% of the value of the home.
And that's still fantastic. If you can take that money, I mean, I've heard of people taking that money, Larry, and reinvesting it in, maybe they're picking up assets that are on sale, fire sale, bargain prices. They're doing lots of other things with it besides just aging in place. Am I right?
I mean, the reality of it is that you got to go through counseling to get one of these loans, but that counseling session is going to remind you, don't spend the money frivolously. So, but it doesn't take you long to figure out that if I could get an extra $100,000 that's sitting in my house that's appreciating at this amount, and I can put it to work in this over here, and I think I can get a better return, you can certainly do that.
Right. So now I'm going to come to the part of this whole thing that is probably the most emotional part, and that is the number one source of opposition to a reverse mortgage that I have encountered or read about is the heirs. Okay, the people that were thinking they were going to inherit their childhood home, and now they found out mom and dad did a reverse mortgage. And of course, we want our parents, we tell them, hey, we want you to be happy and spend your money. Don't save any for us. But that's not really the truth. When you go into these to do these deals, what's happening with the kids and the grandkids?
Well, number one, it's never a grandkid issue because they don't get a vote, right? But certainly what we recommend to anybody borrowing the money is that you have a conversation with the kids and you let them know what you're doing so that there are no surprises. But let's be honest, there's a group of kids out there listen, you might be different, Tammy. My son, who lives in St. Louis, Missouri, I live in Savannah, Georgia. My son does not want my home. We've already moved out of the home he grew up in, right? So he's not interested in my home. Now, he might be interested in whatever asset he can get, or whatever cash he can get out of my home. And we tell borrowers all the time is that, let's be honest, you want to leave the house to the kids. Well, the kids don't want your house. On the way back from the cemetery, they're going to stop by the ERA office and put that house up for sale and hope they get a bucket of money out of it. There is an emotional thing if it's your childhood place and all that. But the reality of it is we try to have a conversation with the kids as a kind of a third party and ask them, your mom and dad need an effective way to increase the cash flow in their life every month. How would you suggest that you do it? Can you supplement their income with money like they used to do you? Can you pick up some bills for them? Then they may not want to do this. But you don't want your mama eating cat food because she can't afford the prescription. And here's a very effective way to be able to allow them to live comfortably in their home to the end of their life, where you're not coming out of your pocket and they're not on any kind of assistance. They're self-contained. And that's the conversation we try to have with them. But you're right. The people that you hear poo-poo these things are always sour grapes because they thought they were going to get money out of a home. There wasn't any to get in there. So you're right about that, but that's more of a family dynamic issue. Don't be gone from my life for 25 years and then get mad because there's no income coming, right? So that's kind of a family dynamic.
That is a family dynamic, but it's important, again, to have that conversation with people.
Yeah, I think you have it. Listen, I believe, and most parents won't. They just won't do it. They don't want their kids to know either how much money they got or they don't want their kids to know how broke they are. Now you got to remember, the average retiree in America, and that's a big old broad paintbrush, but the average retirement in America, the value of their home is their number one largest asset. The average 401k IRA balance when somebody goes to retire in America today is something around $160,000. And so now they're living, listen, we do these all the time. Listen, we all had good plans we thought was going to happen. But Tom Hegna, who I like, he's a very well-known, financial communicator, a very smart dude. He says we got to remember what got us to retirement is not the tools we need to get us through retirement. Think about that a minute. Living on, let's be generous. They got $200,000 in their 401k in California, and they're going to live off of that and their 2 Social Securities, right? Well, that might last a little while, tight, but what we don't ever remember is that one of those spouses die, then one of the parts of that Social Security bucket goes away. And people that have aged together, been married for 50 years, one of them dies almost always, not always, but very frequently, the remaining spouse has a loss of somebody they love terribly, but they also have the loss of a big chunk of income. And that is not a good thing. Everybody's deal is different. And my job as a reverse mortgage specialist is to interact and interface with the borrowers, their financial advisors, whoever is CPA, tax, whoever it is. And if they want to, the kids. Most of us really not that crazy about our kids, but we love our grandkids, right? So what we tell everybody too, because I don't want to forget this, if you want to leave something for the kids, and that is very admirable, why not give it to them with a warm hand instead of a cold hand? Why not give them some money out of there to I don't know, whatever they want to do it with. The other way to do it, if you want to leave money to the kids, the most efficient and effective way to do it is buy a life insurance policy. You really have now leveraged your money because you're buying, you're buying dollars for something. It ain't pennies on the dollar at 70, but it is an effective way to do it. So there's all of that is a holistic, and I hate that term, but it's a holistic approach to a retirement income. And that's what we try to do.
There's nothing wrong with that term, actually. People have appropriated it for a variety of bad things, but in general, you should take a holistic approach to your financial life, just the way you would with your health or anything else. I never thought in a million years that I would be interested in the subject like reverse mortgages. There is so much to it. There's so much more we could say as far as, who qualifies, who doesn't, what the process is. And I could actually do a whole other show, Larry, on just the procedures that a person goes through. But instead of doing that, I would like you to tell people about your resources and how they could get a hold of you, what states you can operate in, and so on and so forth.
Well, we are licensed in 31 states, and we are very powerful down the West Coast and the East Coast. We are less powerful along the Mississippi River. So if you live in California, we can help you. If you live in Colorado, if you live in Oregon, Washington, we're good to go. If you live anywhere along the eastern seaboard east of the Mississippi, other than the state of Indiana for some crazy reason, we're good to go. If you live in the middle part, we would farm you out to, we have referral partners all over the country that we would hand you off to and help you that way.
What's the name of the company, by the way?
Well, I work for a company named Senior Reverse Mortgage, which is really a subsidiary of Jet Direct Mortgage. We use 5 different reverse mortgage lenders so that we can always find different states have different rules, and different lenders like to work in those states. Some like those states and some do not. Texas, for example, where your folks are from, is a tough state. Both of the borrowers have to be 62. And so there's some proprietary products that are out there now that will allow us to actually do a reverse mortgage down to age 55. But they're not in, one lender might be in this state and one lender might be in that state. So we try to look at all five of our lenders and pick the one that works the best for the individual inside the state. We're doing one right now in Maryland, and there was only one company. The lady, one of the borrowers was 55, 56. Well, there wasn't but one company out of the five that we have that would actually do that loan, but they're going to do it.
Perfect. So this is just like any other kind of loan. You're shopping it around. You're trying to get the best deals, trying to get the best terms. How do they get in touch with you if somebody's out there and either they want to know more about it because their parents are considering doing it, or they want to look into it for themselves?
Yep. The easiest way to do it is just call me. Area code 912-414-0981. That's my personal cell phone, 912-414-0981. Call me or text me. Now we've got, all these fancy emails, and I can give you that. It's l.speir, S-P-E-I-R, at jetdirectmortgage.com. I always try to communicate initially as quickly as possible in person because these are very personal decisions.
They are very personal decisions indeed, and they involve sometimes some emotional stuff. And
Yep.
I think that's great that they make people go through counseling, because I certainly
Yep.
think that they need to know, have some clarity on why they're getting this money out, what it
Yep.
can and can't do for them. I mean, it's really great that they're doing that. I wish that they did that with all financial things, actually. It would be
No kidding.
not a
Yeah.
bad idea. But anyway, this is fascinating, and I wish I had more time to spend with Larry. But if you want to call him, I'm going to put all this information in the show notes down below of the description of the podcast, and you can go there, or you can contact me directly, Tammy at yourmarketingtherapist.com, and I can get you that information as well. Who'd have thought, Larry, that this would be such an interesting conversation, again, about reverse mortgages, about keeping yourself safe as you get ready to retire, or you're helping your parents out.
Yep.
And you want to make sure they make good decisions. So thanks, Larry, for joining us.
Tammy, if you'll just let me, many of the people listening to this thing are in that Oreo generation, right? They're raising kids and they're helping their parents all at the same time.
Absolutely. Been there.
And so, one of the things that I think sets us apart from other people, not everybody, because there's good people in our business, but I see myself, Tammy, first and foremost as an educator. And it's my job, whether it's this or other stuff that I've done over in the same arena. I tell them, I'm not going to sell you anything. I'm going to educate you. I'm going to help you decide whether it's a good decision or not. Ultimately, you're the boss. You got to decide. And then I am credentialed to put that plan into action for you if that's what you decide to do. But I'm not going to sell you anything, but I will certainly help you buy it if it's the right thing for you.
Absolutely. And also, if you're an advisor, a financial advisor listening to this, there are opportunities for you to leverage this reverse mortgage opportunity and leverage it for your benefit, for your client's benefit. So you can also,
number one, thank you for that too, Tammy. And I'm going to shut up because I can tell you're trying to end this. But for a financial advisor, one of the questions you got to ask yourself is, are you doing the right thing for your client if you're not at least helping them address what could be the single biggest asset that they have access to? And it used to be they would say, that you may have a compliance issue. Today, if you're not talking about reverse mortgages with your client, I believe, and a lot smarter people than I am would tell you that you may be out of compliance. So just kind of, we love to partner up. We try to work with advisors, CPAs, elder care attorneys, any of those sort of professionals, we're happy to do that. We appreciate the opportunity to be your guy.
I appreciate your expertise in this area. And again, if you need any help from Larry, look at the show notes there. And, it's something that all of us need to be thinking about because it comes faster than the whole thing of retirement. So I want to thank Larry Speir. And after I end this recording, then stay on for just a second.
Yep, be glad to.
You've done it. You've faced the fear and triumphed. Thanks for listening to the Safe Space Podcast with Tammy D. For episode information or to suggest a guest or topic, go to saferpodcast.com.